Hello. In this video, we'll be going over non-cash acquisition of property, plant, equipment, or intangible assets using equity issuances or donated assets. Companies can acquire assets either using cash or sometimes they pay without cash. And these can be anywhere from deferred payments, which we've gone through in the previous videos. They can issue stock as a form of payment. They can donate the assets or exchanges of non-monetary assets for other assets. In this video, we're going to be going over number 2 and 3 and the accounting for those non-cash acquisitions. It's important to note that the assets acquired in non-cash transactions are valued either at the fair value of the assets given or the fair value of the assets received, whichever is more clearly evident. When we issue stock for an exchange for an asset, we receive the asset, we receive an asset, and we give stock as a form of our payment to the seller. And the transactions exchange the value of the asset can either be the fair value of the assets received, if that's known, right? So it's either the fair value of the asset or the fair value of the stock which we have given as a form of payment. If those stock are actively traded, that's really easy to know what the market value of those shares are. The way we would record that is on March 31, 2027, the Elkhorn Company issued 10,000 shares of its no par common stock in exchange for land. On the day of the transaction, the fair value of the common stock, evidenced by its market price, was $20 a share. So we would just take 10,000 times 10,000 shares times $20 is 200,000. So we would debit land 200,000 and credit common stock because we're issuing common stock, and when we issue common stock, it's a credit. So that's pretty simple. Sometimes an asset is acquired using donated asset, and usually by donating an asset, it's something to entice the buyer to do something, to purchase something that actually benefits the donor. For example, if a developer owns land, they might help pay for some of the cost of a building in order to entice a company to actually build on their land. Also, sometimes companies receive incentives from the government, like a local government unit might provide land or pay for some or all the costs of a new office building to be built, in their area, because that would help them generate jobs and revenue, and they would collect taxes, so it benefits the donor. That's what kind of that means. When you have a donated assets, you record them at their fair value based on either the variable market price or an appraisal value, and revenue is recognized. There is no guidance from GAAP as to how donated assets should be recorded. So most corporations use the guidance used by nonprofits because nonprofit companies, organizations receive donated assets all the time. And what they do, what a corporation does, if they have a donated asset, let's just say they debit the asset, whether it's equipment or building, and the credit is going to go to revenue. Because really, what else is the company going to credit? If they were to receive cash, right? If a company would receive cash as a donation, they would debit cash and they would credit donation revenue. So similarly, if they receive an asset that was donated, they're going to credit revenue most of the time. Let's look at asset donation. Elkhorn Enterprises decided to relocate its office headquarters to the city of Westmont. The city agreed to pay 20% of the $20 million cost of the building, $20 million cost of building the headquarters in order to entice Elkhorn to relocate. The building was completed on May 3rd, 2027, Elkhorn paid its portion of the cost of the building in cash. So the city pays 20% and Elkhorn pays the other 80%. So how does Elkhorn record this entry? They're going to debit building $20 million because that's the cost of the building. And for the portion that they receive from the city of Westmont, it's going to be credit revenue, donation of an asset for $4 million, which is 20% of the 20 million. And then they themselves, the Elkhorn Corporation, pays cash for the building, so they're going to credit cash. Let's look at a couple of concept facts. Shackelford Corporation acquired a patent from its founder, Jim Shackelford, in exchange for 50,000 shares of the company's no par common stock. On the date of the exchange, the common stock had a fair value of $22 per share, determine the cost of the patent. The first indicator of fair value is going to be the fair value of the assets or the debt or the equity given. So in this situation, it was in exchange for equity. So we're going to take the 50,000 shares times $22, and that's going to determine the cost of the patent, and that equals $1.1 million. Let's look at another concept check. The County of Santa Clara gave a parcel of land to the 49ers company as part of an agreement requiring the 49ers to construct its football stadium on the donated land. The land cost the county $12.8 million when purchased several years ago and had an appraised value of $20 million on the date it was given to the 49ers. As a result, what is the donation under GAAP that the 49ers should record? They should record the asset at the appraised value of $20 million, and that's going to be revenue of $20 million to the 49ers company. It doesn't matter that it cost $12.8 million to the county. It's really at the appraised value. The fair value of the assets received is what it's going to be recorded at. And because GAAP requires if a company receives a donated asset, it must record the revenue and amount equal to the fair value of that asset, which is $20 million.